So our next Informed Investing session is a panel discussion looking at building resilient companies, investor perspectives on managing African startups. So the moderator is Fope Adelowo. She co-heads the FinTech and Financial Services Practice and Venture Capital Strategy at Helios Investment Partners. Helios, as most of us know, is one of the largest private capital investors in Africa. Prior to Helios, she worked in the Principal Investment Group at Cardinal Stone Partners in Lagos, Nigeria, and she also served in various roles in the Emerging Markets Structured Products team at Goldman Sachs here in London. She holds an MBA from Harvard Business School and a Master's in Engineering from Imperial College London. So over to you.
Thank you. Good morning, everyone. Super excited about talking about this panel and sharing the stage with my very esteemed panelists. I think we are obviously at a little bit of an inflection point when you think about startups in Africa. And I feel like today's conversation hopefully sheds some light as to how investors are thinking about what, more broadly, the VC ecosystem looks like going forward. But in particular, I think most of us are keen to see more success stories coming out of African startups. And so the question is, how should we as investors be thinking about managing startups, about our investments, and about growing these startups so that we can have more success stories? And so, to do that, I will let my panelists just introduce themselves. I think, anyway, as we go along, some of the topics we'll talk about are just how do you build resilience in startups, and how do we think about the new success stories for the next decade. But let's start with introductions with everyone here on the panel.
Hi, everyone. Christophe Dumontiel, principal at Beyond Capital Ventures. Started my career off in management consulting before moving to the VC impact space about 7-8 years ago, and have been with Beyond Capital about 3 years. Beyond Capital is a multi-asset firm investing in 2 of the top 4 emerging markets in the world, both East Africa and India. We target seed to Series A companies across healthcare, financial services, and climate. And within climate, ag and mobility, e-mobility are 2 of our larger pillars, along with climate data. So across all of those companies, we do look to be active investors, build resilient businesses, and help our companies succeed. And with our approach, we have had 100% graduation rates across all of our companies, 5 markups, 0 down rounds, and so I do think it is possible to build resilient businesses in Africa.
Morning, everyone. My name is Bitel Dineyan. I'm the managing partner of ODBA. We're an early-stage venture capital firm. FinTech, EdTech, HealthTech, and logistics is our play. We do have, obviously, a deep love for FinTech. African-focused, we do invest in the UK and the US as long as there's an African dynamic to it. 24 portfolio companies, been around for 5 years. We've, have had some very successful companies in our portfolio, and we're really excited about the possibility that Africa continues to offer for European investors. Thank you.
Hi, everyone. I'm Rolake Roshiji. I'm the Africa Director at SeedStars. SeedStars is a Swiss venture capital and entrepreneurship support organization. So we do 2 quite different things and try and work closely together. So on our venture capital side, we have 3 funds that are focused on Africa. SeedStars Africa Ventures, which invests late stage from Series B upwards. SeedStars International Ventures, which invests pre-seed and seed. And SeedStars Youth and Wellbeing Fund, which also invests pre-seed and seed. Across those funds, we've got different strategies and focus areas, but FinTech runs across all 3 of them. We're also interested in agriculture, logistics, health, and financial inclusion in general.
Hi there, I'm Anton van Vlaanderen. I'm a partner at 40i Capital based in Cape Town. We're an early stage VC fund, seed Series A. We got into the space by actually starting our own business, software distribution business in the early 2000s. Had some success with that business, and then ended up angel investing in Cape Town for our sins and lost a lot of our own money. But saw that there was a gap in the market. So in 2009, we set up our first formal VC fund, very early stage fund. And since then, we've managed to raise 3 funds and invest pretty much sub-Saharan Africa. Tech businesses, B2B, scalable tech, and yeah, based in Cape Town.
Okay, great. Thank you very much, guys. So let me start with the last 2 people on this side. So I think, well, I guess for you, Rolake, and I guess Anton, Rolake, you have multiple stages, but Anton, you invest pretty early. And I'll be curious to know, actually, maybe it's a question really for all of you. We talk about building resilient startups. So what does resilience look like? And I think, in my opinion, if you're a later stage VC fund, resilience looks quite different in terms of the maturity of the company, what you expect them to be doing going forward. And when you're earlier, I actually have a question in my mind. What does resilience look like? Because you have companies who are thinking about product and, just surviving. But at the same time, we're talking about resilience. So yeah, I'd love to hear what it looks like, what you guys look for, what you define as resilience.
Shall I kick it
You
off?
can start from that end, and we can come this way.
I think for us, having invested in quite a few companies over the years, and there's many things, I think, but the one thing that we found is quite a big differentiator is the founder and how open they are to guidance. So you come across some founders that feel that they know it all and they just see an investor as money. We tend to like to partner with our founders, and generally the founders that are more open to coachability or are more coachable and generally open to guidance and listening, using investors as a sounding board really helps a lot to make a success of their business, because it's a very lonely journey, as you guys know, especially in the very early stages. So that is one thing that we think is quite important.
Yeah, we've got a very similar philosophy. We try and start off with the founder. And when we think about resilient businesses, we're thinking about who are the founders that can stick through it, even when things are really, really tough. We've done quite a bit of research, because we're investing not only in Africa, but in Asia, Middle East, and LATAM. And we've seen that the founders in Africa are, in general, a lot tougher, because there's no other alternative. There's no alternative in other markets. Even if the startup fails, they may go and just join some other large company. But in Africa, the options are fewer. So we're very much focused on founders. We have a value creation platform, which is really, really in-depth. It involves a 3-month growth program where we match up the founders with tried and tested mentors and operators who've done it before. And yeah, very similarly, the ones that do well are the ones that are open. So we're really invested in that coaching process, and especially with our earlier stage funds, so Seedstars International Ventures and Seedstars Youth and Wellbeing. It's really about taking them through this coaching journey. And because Seedstars also has the programs arm of the business, which is only training. We only do training and then some grant investment and a bit of blended finance. That is really our philosophy. So working with founders and upskilling them, pairing them with mentors, giving them access to our investor network, and just really supporting them closely.
To add a bit to what both my colleagues have just mentioned, we like to say, resilience, grit, but we're early stage. We have a certain amount of time to get to know the founder. How do we draw these conclusions? How do we put together a picture to enable us to make these decisions? And one of the things that has been good for us is the founder's knowledge of the market. Because that's very, in our opinion, especially in Africa, it's very important. Majority of the things that we do practice in Africa, we have adopted from Silicon Valley and Europe, which is no problem at all. It's a starting point for us. But some of the things we can't import are, interest rates of 2-3%, where we're dealing with 25-20%. We can't import access to capital, which is ridiculously difficult, and also the infrastructure gaps. So it's important that the founders that we do back have a clear understanding of the local markets that they operate in. Because if they do have a clear understanding of Nigeria, Egypt, or Kenya, wherever they do operate in, they would understand that they're going to, in terms of how they're building their companies, it's going to be very different to how they build it in America or Silicon Valley. There's that nuance, that local nuance, that enables them to make much better decisions, which in my opinion enables them to deal with when the markets do turn, right? When the markets are good and great and interest rates are low, yes, we go out and we seek as much capital because capital is cheap and accessible. But when the markets do turn, a number of these founders have never built in a down market. Not only have they never built in a down market, they have never managed organizations before. Some of them have not been in senior positions in organizations. So the sort of things that we do look at is clear market understanding, understanding the nature of the country which you do operate in. Some of the other things that sometimes we do look at, it's not a given, but it does help, is team. Because a variation in team would help when a company does come into difficulties. It does help in the general resilience of the company overall. So a very clear understanding of the market which you operate, and not always the case, but also a clear path, a clear long-term dream of what you think of your company. Because when things do turn against you, it does make you a bit more resilient. When you have a much clearer picture of what it is you're trying to achieve, it just makes things much easier. So those are the sort of things that we look at: market knowledge and differentiation across the team.
Yeah, and I think the last that I would touch on that is, similarly, at an early stage, right, conscious leaders are something that's very important for a company to succeed. So we essentially evaluate across 7 different functions, right? Your employees, your customers, corporates, government, environment, community, right? And so we look at all of these different things and we say, how are you approaching them? Are you taking a dynamic and integrated approach to solving or supporting or enabling these different ecosystems that touch your business? And are you thinking about all of them and thinking about how it could affect your future growth? Now that sort of touches into the grit. And then to think about how does this actually manifest as the company grows. At an early stage, one of the biggest things that I can see is, do you apply cost controls, right? Everyone says at an early stage you should be growing, 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 growing. And then your liquidity starts to run low. Do you have the grit? Do you have the fortitude to think about something like cost controls, tamp down growth that extends your runway and continues? That's one of the biggest things that afflict companies at an early stage. So you can start to think about how do you think about all those stakeholders, how do you then approach your business into something just as technical and simple as a cost control at an early stage. And then as the company grows, which we can touch on a little bit later, we expect to see some of those things like professionalization, governance, having a stronger hold of your financials that we won't necessarily see, and I can't evaluate at that point, but everything across the spectrum, whether you're early, you're late, you are looking for traction, you're looking for growth, you're looking for improved margins. And so I don't think that quite differentiates what defines resilience, because a lot of companies have that. But in the face of what you are doing as you build that business, are you able to manage it effectively while thinking about those stakeholder communities that touch your business, I think is quite important.
So thank you for that, actually. You started to touch on a few points, which, look, if we look at the number of pivots that happened in the startup ecosystem in the last 12 months, it would imply that maybe we as investors were taking the wrong approach. And as you said, importing models from elsewhere into Africa. And so, the question for all of you, because you've all said really nice, glowy words about, growth and governance, they're all great. But I feel like we've all had to make changes in the last 12 months about how we think about value add and how we support our companies or how we think about governance. And we've seen a number of blow-ups actually because of, poor governance, even at the early stage. So my question to you is actually, how have the last 12 months changed how you think about ensuring that your portfolio company, so this is from your perspective, not what you're looking for in the company, from your perspective, what are you doing differently now to ensure that you're building resilient companies, you're supporting them in a resilient way? And how do you think about things like governance, even at an early stage? Like, do you enforce it? Is it needed? How do founders react? So yeah, maybe just, yeah, I would love to hear your thoughts.
Yeah, and maybe I can touch on this because that is one of the things that we do at Beyond Capital as we move from a company from seed to Series A, and then obviously beyond. Yeah. You know, for us, we do lead a majority of our rounds. We've led about 70% of the companies we've invested in. So with that, we do try and take an active position. We do like to hold the board seat either as a member or an observer in many of those cases. And so we do like to advise the company and support it along its growth path. Now, that being said, I do think as a place as an investor, I'm not an operator. I'm never going to manage your business as well as you are, even if you are a terrible entrepreneur and founder. I'm not an entrepreneur. That is not my role. My role is to support you and help you think about other ways that you can succeed as an entrepreneur. But I'm not there to replace you. But that being said, as we grow a company and we do have an active role in governance and we support the company to make those changes, we do like to influence. And one of the biggest things that I've found with early stage companies that they struggle with is changing their management at the right time. The right people from 0 to 1 could be very different than the people that are taking you from 10 to 1,000. And my role isn't necessarily to go and say that this is what you should do. If you are a conscious leader, if we've evaluated correctly, you're identifying these things along the way. And you're making those decisions. And our job is to help support you and say, is this the right decision? So an early stage CFO or a finance manager could be great in that role. But as you grow and you get to a Series A or a Series B, you need someone who understands how are you capital planning? How are you managing your equity? How are you managing your debt? Are you using the right capital for the right point? And it could be very different than that original person. And that's where I think, you know, the governance structures become important to help the company find its way and become more resilient and find the right people to support them along that path.
Well, for us, it's been really interesting. We started off 4 or 5 years ago telling our founders, you know, grow at all costs, you know, grow as quickly and as you can because there was access to capital. Now we're telling them be sustainable, make sure you earn revenue, don't employ anybody that you know. What I'm getting at is that we all seem to be learning this as we go along. Yes, there's some of us that have been, you know, veterans, that there's a lot to learn from. But for all of us, both the VCs and the founders, it's all fairly new. We've not yet done a complete 10-year cycle, or maybe some have, right, to really see how things have panned out. So initially, I remember when we did start investing, you know, I'm quite experienced in Africa. I've run businesses in Africa for a while, and I understand very clearly all the problems and the difficulties in Africa. When the American and the Silicon Valley capital came into Africa, there is absolutely nothing I would tell a founder. He would not listen to me. He made me seem as if, you know, I was hindering his creative abilities and me telling him some of the harsh realities in Africa, some of the problems that you will face, and money will not get you past those problems. So I suppose what I'm trying to say here is that in as much as it has been difficult, I think it uncomfortable, but a natural progression. I think it's some of these things had to happen. Capital was new to a young group of individuals that were really excited about it. So, you know, they did the best they could under the circumstances. When capital turned, I mean, we've got to bear in mind that these difficulties are global. Even established businesses, you know, were seriously affected. So, again, for us, we do say we guide our founders. We say we introduce them to, you know, we get better employees for them. We introduce them to businesses. We assist them in every way possible, like every VC does. I'm sure if you go onto all our websites, we will go into detail as to how we aid founders. But I think we're going to have to evolve and double down on exactly what it is we say we do. And if it is that, for those that are doing it, fantastic. And for those of us that claim that we're doing, and we have to do better, right? We definitely have to do better. We've got to find this line where we are able to guide and add value without hindering that innovative, creative mind of the early stage founder. Because, like I said, it is still very new in Africa. And it's a very different climate from the States or the US. And the downturn has made us all, we've all come to terms with the reality and the vast differences. So I think it's just doubling down on the advice and the guidance that you do have, building better relationships with the companies which you do invest in. As you mentioned, I have no intention to be an operator. Yes, I am an entrepreneur, but I have no intentions of coming in to run the founder's business. So I think it's doubling down in terms of ways in which we can make them accountable and ways in which we can actually help them to fulfill their goals.
Yeah, I mean, for us, the last 12, 18 months has been a rude reality, and it's been very, very tough. In terms of governance, so Seedstars International Ventures and Youth and Wellbeing, we're follower funds, so we don't take a board seat, but we do encourage our startups that at least when they're moving to Seed Series A, that they need to have a board established. And then with Seedstars Africa Ventures, at that stage, we do take a board seat. And for us, really, things have been tough. They've been tough the last year and a half, and we've had companies in our portfolio really, really struggle. Let me give an example. We have a company called Omni Retail, a B2B buying platform from Nigeria. We invested in them at seed stage. They did very well, and then they started running into different issues, had different problems, and with the FX situation in Nigeria, there were so many things working against them. But we were able to really support them, even though we didn't have a board seat. But we worked really closely with the team, with the founder, introduced them to different people who could advise them, help them, connected them to others in the space, and now they're raising a really, really large Series A and looking fantastic. So I think in these tough times, it's about not running away scared, but it's about really sticking with your guns and the businesses that have the right fundamentals, really sticking with them and supporting them where possible. So definitely, we do not want to be the entrepreneurs at all, but we want to be working really closely with the founders, actually understanding the nitty-gritty details and issues they're facing on a day-to-day, because with our experience, and I'm sure it's the same for my colleagues, we can plug them in with others who've been through the same thing before. So that's really how we try and support and what we've been doing in this difficult period.
Yeah, cool. I don't think there's too much more to add. I was just thinking now that maybe one of the lessons we've learned from the good, well, not the good years, but the very fluffy years of 2022 when funding was falling from trees. But I think, and I spoke to one of our founders yesterday about this, but I think a lot of the companies that we were involved in were growing for the wrong reasons. I think they were trying to expand market-wise, they were trying to expand revenue to levels with negative margins in some cases, and it just was unsustainable. And they were trying to just increase revenue so that they can know that they'll raise bigger funds and at higher valuations at the next round, which I think has burnt a lot of people now. And I think as long as we learn from that, going into the next cycle, I think we'll all be better for it. So yeah, I think that's going to help as well from a resilience perspective.
Super interesting. Thank you, guys. It actually, one question in my mind is, as we've been through this cycle, as you've all said, do you feel like in some ways your strategy has changed, like what you look for in companies? And it's a quick yes or no, and why, that you guys can run through.
Shall I start? I'll say I still think we look for the same thing. We back the teams, back the people, and it's got to be a good market fit. Otherwise, I don't think that's changed too much.
Same strategy has not changed actually.
Yeah.
No.
Well, in my case, strategy has stayed the same, but what has fundamentally changed is we've always claimed, or we've thought that we're contrarian. We've always thought that we drive our own path. We've raised the capital from the LPs. We've told them about what it is we want to do. And I was always very confident that I'm very hell-bent on what it is I want to achieve and the sort of founders I want to back and the sort of companies I want them to build. So even as a VC, it's, I would like to admit that the former and what everybody else is doing, what all the other bigger funds are doing, you run the risk in shining out like as if you don't know what you're doing, or and so from an LP point of view, if anything has changed, is we're doubling down on what we believe in, and going forward, I think that would be a number of things that a number of us needs to do. We don't all have to have the same strategy. We should not be scared to sound different, because at the end of the day, in all our big funds, at the very most, there are about 100 or 150 LPs, and there are thousands of LPs out there. Africa's problems are not unique, but they're very different, and it takes different individuals. We can all win with different strategies. We can learn from each other. Some of us would fail, some of us would do better. But we say it all the time, everybody says it all the time, but conviction, really sticking to what it is one believes in, and not trying as much as possible, not being driven by Silicon Valley or London. So I suppose what that means is we need to tell the story better to our Silicon Valley and to our European counterparts. We need to make them understand in more detail. If that's where the capital is coming from, we need to explain and tell the story much better.
Yeah, and I would echo, I don't think our strategy has significantly changed. I would say that there are a couple nuances that have changed our thinking about companies that we look at. A very simple one, solo founders versus multi-founders. In times of great strife, it is very difficult to be a solo founder. And that's what we found over the past 2 years. Companies that had multi-founders that could, one, share amongst themselves, take some of that burden off of each other's shoulders, had less of an emotional roller coaster. A single founder, some days it was great, everything's going well. Some days it's like, oh God, I'm never gonna raise another dollar in my entire life, right? With multi-founders, you don't have as much of that fluctuation. And so that's what we did find is stressful periods could just change how you think about a single founder in that situation. Now that's not going to say, have we changed our direction, that no, we're only investing in multi-founder teams. It hasn't. But it just does make you think, okay, now when I evaluate this business in a moment of hardship or in a moment of tight liquidity, should I take that into account? How much stronger is the management team? Do they have a sounding board as one of their senior management people that can relate to them as a founder? Those sorts of things I think have changed over time. But across everything else, what we're looking for in businesses, what we tend to think from a financial perspective, that's relatively stayed the same.
Thank you. And part of the reason I asked that question is because for us, I mean Helios as a platform, one of the big learnings from multiple cycles was just trying to figure out how you deal with FX, right? And obviously you can't deal with it. It's just how do you think about what you're investing in to manage that FX risk. And some of it for us is just, thinking about diversification, geographic expansion, diversifying the currencies, or just investing in high growth businesses that hopefully outpace the rate of devaluation. And so I know a lot of founders in the last 12 months as well have been through this process of, I cannot double down on Nigeria alone anymore. I need to expand into other markets. And Egyptian, North American founders want to go into the Middle East, which obviously makes sense. But at the same time, you're investing resources into going into multiple markets, which you could be using to double down your market. So just curious to how you've seen that evolve in your portfolio companies and how you think about it, like when you're making new investments and you have founders whose goal is to be Pan-African, how are you advising them going forward on that?
Yeah, I'd love to start here because this is actually something that we see a lot, right? When you think about a traditional Series A, there are 3 things that almost every investor has said they wanted to see over the past, 5 years. Multi-market, EBITDA positive, month-over-month or quarter-over-quarter revenue growth, right? That's what you want to see going into a Series A. That kind of ends up being the holy grail. I still think EBITDA positivity, if it's not coming by a Series A, You have to be getting very, very close because people are getting nervous on sustainability and liquidity is tight. So I don't think that's changing. I don't necessarily think that looking at month-over-month revenue growth, we want to continue seeing that. So with FX, it has been an optics issue where local currency revenue growth has continued to grow, but when you put into USD, it isn't. And fundamentally, that shows you, you know, the value of that business in an African context compared to anywhere else you can invest in the world. Think of it as opportunity cost, right? But fundamentally, the business is still growing. So we look at it from a local currency perspective and assume FX is a volatility blip. But multi-market is where I have an issue. The amount of companies that have limited funding that then push for multi-market and absolutely crush themselves needs to stop. Make yourself successful in a single market. Maybe a market, you know, for us, East Africa, maybe Rwanda doesn't typify, right, the rest of Africa. It doesn't typify what you would see in Kenya or Nigeria or some of the big four. But succeed, live, grow your business, be sustainable, be pragmatic. You know, if multi-market is the only indicator for your investors, maybe it's not the right investor. I do think there are cases for it, but we're seeing a lot of companies push for what investors want at a Series A, and it's being detrimental to their business. And I think, you know, we need to take that into account of not necessarily looking at a company and saying, hey, you haven't expanded into Nigeria yet. It's such a great market. I'm like, have you done well in your current market? Are you succeeding? You know, does it typify what you're going to do in others? And then I can grow off that.
Fantastic. Very, very well said. It's a tough one. And the reason why I say this is this. As far back as I can remember, for the last 30 years, devaluation has occurred in Nigeria every 4 years without fail. So that means devaluation is part and parcel of Nigeria. It's not no surprising thing. It's not something that has suddenly come about. It has happened since the 70s, almost every 4 years without fail. This is what I mean about market knowledge. So if that's the case, that devaluation has happened all the time, inflation has been difficult, and access to capital has been the same for this long, is it that we've drawn a picture of Africa and business in Africa that's not realistic, or one that's not true? And the reason why I say so is, at the moment, the wealthiest men, women in Africa have built their companies in Africa, listed on African markets. We know a number of them, the Dangotes, the Elumulus. And they've done well over the last 20 to 30 years. They have continuously grown their businesses. But then a new company comes about. We give it a period in time in which we want it to grow very fast, and we pile up all this pressure, almost breaking the company before the company sees the light of day. Meaning, I know we don't like it, and this is why I think we need to have a different conversation with our investors and policymakers, that it's just the reality of Africa. Every 4 years, that dollar revenue that you have built up will take a hit because of the uncertainties that occur. And that's got nothing to do with the founder. That's just the micro and macroeconomics of doing business in Africa. But typically, we just want to ignore that. We just want to pretend that that's not the case, that we're not, those are some of the difficulties in Africa. And like I said, some companies, some of you guys are doing really well, where you're looking your investors in the face and you're being very honest about this. It will be more difficult to get money from the institutional investors or the LPs, but when you eventually do, you'll be able to back and build companies that are going to do phenomenal. They're going to do really well. So it's being honest, I suppose, honest with yourself. Also, obviously honest with the investors, because investors are a certain way when they have access to capital. I mean, back in 2021, when I was still thinking about opening up the fund, I could speak to everyone. Fast forward to 2022 or 2023, no one wants to speak to you because they have opportunities in their own markets, right? Rather than come and invest, in us. So I think it is, the downturn has been really interesting for all of us. It's a good opportunity and a good chance to really rethink Africa, rethink the positives and the negatives and the realities. Because like I said, I hope it would not be the case, but I would expect at the very latest, probably by 2028 or 2029, we will see further devaluations in different African nations. And like I said, I'm not, it's sad, But if Tony Elumelu, Dangote, GTB, and all these people have been able to build phenomenal companies within this devaluation and these downturns, there is definitely something which we are missing when we're building early stage companies. And these are the sort of things that, like I said, we're thinking about in detail to ensure that by the time we get to the second or third cycle, we'll be able to be saying different things from what we've been saying for the past 10 years.
Thanks. So I agree with what Bite said, but having said all of that, yes, FX has been an issue in Nigeria decade after decade. But there are ways to de-risk against it. And I do think, as much as you're not forcing a company to expand when they do not have enough to really spread out and expand, when there's the opportunity and when there are the right markets that fit the business, then yes, for us very much, diversification across geographies makes sense. The company I mentioned earlier, Omni Retail, Nigerian-based, they actually first expanded to Ivory Coast, and it didn't go well. So that was an example of where just because, Ivory Coast is another large market, and no one else, not so many other people are doing what you're doing, it didn't go well. But now they're having a pretty decent expansion into Ghana, into Cameroon. So I think when the thinking makes sense, diversification into other geographies, despite the FX challenges that we've seen in many countries, can help hedge against certain risks. And this is because, okay, what may be happening in Nigeria may not be happening to the same extent in another market. And then when Egypt has its own issue, perhaps then Ghana or someone else is recovering. So I think it does make sense where the company is doing well enough and they actually are able to expand. Another example, Pezesha, one of our portfolio companies, their digital finance platform from Kenya. They did very well in Kenya, and then they've now expanded into Ghana, and they're doing excellently there as well. So I do think kind of spreading out into different regions that are different macroeconomically to where the company has their stronghold can help de-risk with these issues.
Anton, I think you have to continue on the positive note, so no pressure.
No, I was just going to say, and I think it's positive, but I think you've got to, as a founder, you've got to first and foremost, you've got to build a good company, and I think a lot of guys are building companies to raise money, and this is like a bad sort of trend that started to happen, whereby it's all great to be in the tech crunch and be raising big rounds and all that, but it's not necessarily the best thing for your company. And often, I think what happens is later stage investors also say, this is what we want to see, like the guy said, and but it's not necessarily the best thing for your business. So it's not the same for everyone, but I think we've had a classic example with one of our companies, with Soko. Daniel also expanded very quickly, very fast, and now he's retracted out of quite a few West African markets. So having learned that lesson, you speak to him, he'll say exactly that. So yeah, I think that's just one thing we need to learn as well.
Yeah, and maybe we'll open it for M&A. M&A? We didn't talk about that, actually. We should definitely talk about that. But do you want to take one of our mics? Or okay. I would just say, if anyone has questions, please indicate for the mic. But just on your point, from a later stage investor perspective, so our VC fund invests Series B+, and I think if you claim you're in multiple markets, I think for us we want to see that actually you're winning in those markets. So it's very hard for us to see a business that is in 7 markets, but you have 1%. You haven't grown much in some of the new markets at all. And I think the other points, which obviously I was talking about, is we think you should expand with M&A. There's no need to go try and launch new markets when there's a player there that you can partner with that already has a foothold in that market. I think we have one question.
Hi there. Thanks for the panel. Great speech on all accounts. Alex is us here from the Cadmus Group. We do private sector development programs in Sierra Leone. I'm a senior associate there. I'm also an aspiring VC. Hopefully one day I can get into one. My question is to the panel. How do you balance financial returns with measurable social and environmental impact in your investment strategy? You talked about investing in financial inclusion, gender lens, and so forth. So it'd be interesting to see how you sort of pick your moments, I guess, or pick your firms. And then what sort of metrics do you prioritize when evaluating both potential and existing portfolio companies?
Are you an LP? They should know that before they answer the question. No? Yes? Yeah.
So because SeedStars is split between the venture capital arm and the impact and what we call programs, we have a pretty neat split between how we balance the financial returns and impact metrics. So all our venture capital funds are focused on financial return. We do have an interest in gender-led companies, but apart from that, they are pretty, generalist funds. On the SeedStars program side, everything we do there is linked in some way to the SDGs. So we have a big focus on women-led businesses, big focus on financial inclusion, and it's a very different model. It's not equity investments. We're investing grants. We're investing results-based finance, blended finance, and even we can't even call them LPs. Our funders are very different. So it's organizations like GIZ, USAID, Visa Foundation. So the way that we balance it is we're working with different funders and donors on the impact side, because that's what they're looking for, and that matches our own impact agenda. But when it comes to the capital and the equity side, our real focus there, the only main thing related to impacts would be we're very keen on women-led businesses. Yeah.
I'll try a stab at the first question. I think, our stance on impact is that the fact that just by doing what we're doing, I think we're making an impact. I think it's, if you look at other markets, more developed markets, VC and early stage investing has proven to be hugely successful in terms of growing those economies and creating jobs and doing so. I think it's quite difficult in the early stages to push these with founders to push some of these agendas, because we just find it so hard to even just start a business. Never mind thinking about some of these issues. I think just by getting going and starting, they are they are adding value to yeah.
True.
Yeah.
Well, I suppose it's a weird way of looking at it, but almost everything in Africa is impact. I suppose we're not big enough. I suppose when we do get big enough, we would have a separate fund for impact, and we'll look at it from that point of view. So I just take cues from guys that have come before us and see how they are saying things. But like I said, almost everything, and that's what people don't realize. It's almost like a blank board. We know a lot about the cities, Lagos, Cape Town, Cairo, but beyond that, almost everything is impact in Africa. And not to say I have a problem with impact funds, because I don't, but everything is impact, right? Let's go out there and create more jobs and by creating jobs, you're impacting. So the impact in itself, I don't know, but like I said, I'm still a new kid on the block in this game. So I suppose with time I would really understand what that impact means. Yeah.
Yeah, I would say at Beyond Capital we're unapologetic. No money, no mission. If you aren't creating a sustainable business, you aren't going to live to see another day, and your impact dies with you. So fundamentally, every business, your operational metrics, if you have embedded impact, your operational metrics that you're likely tracking are going to be very similar to some of the impact metrics that I want to track myself. So we see that. But then again, we've embedded impact in everything that we do. We're the first fund to be 2X Global certified because all of our businesses have a unique and impactful effect on women and girls, right? We're still have a very high-performing portfolio. And then we find ways to incentivize impact through financial returns. We offer equitable venture as part of Beyond Capital, where we share 10% of our GP carry in our fund with all of our portfolio company founders. We then incentivize them to achieve gender and climate goals, where they get a bigger share of the LP carry in our fund. We share with them, so we are stakeholders in their business, they are LPs in our business, we align those goals, and we drive change through financial mechanisms and incentives while creating strong growth for those companies.
And That's an excellent way to end this panel. Thank you guys so much. This was excellent, and please give them a round of applause.